What if I told you it's possible to make over 10% yield on cash sitting in your brokerage account? I've been doing it by selling cash secured puts. If you stay until the end, I'll show you a hack to make this strategy even better. This video is not financial advice, nor is it a recommendation. Please do your own due diligence before investing into anything. A put is an options contract allowing the buyer the option to sell their 100 shares at an agreed price at or before the expiration date, regardless of market conditions. This price is called the strike price. In exchange for the option to sell at that price, they pay you a premium. When they buy the contract, you get your premium immediately and keep it regardless of outcome. While you can buy and sell these contracts with or without the cash to cover the 100 shares, kind of like a stock, it's always safer to have enough cash on hand to buy the shares if you get assigned. That's what the term cash secured put actually means. This type of contract makes the highest premium on red days when the stock drops hard. However, if the stock is trending down on the daily chart, you run a higher risk of dipping into the money and getting assigned. You may have heard terms like out of the money or in the money before. This is simply referring to whether the stock is above or below the strike price of an options contract. But even if the stock is technically in the money or low enough to technically be assigned, that doesn't mean a contract is worth assigning. The number where that changes is called break even. If the stock drops below break even, which is the strike price minus the premium they paid you, they can exercise the contract and force you to buy the 100 shares. However, if this doesn't happen, or if they decide not to assign the contract anyway, they can let the put expire and you keep your money. I found 30-day contracts that pay about 1% premiums on my capital. So if you sell your contracts for about that much just once a month, you can make 12% a year on your money. I won't say in this video which stocks I've been selling contracts against, but if you're just getting started, it's usually safer to pick a stock you would have bought anyway in case you're assigned. Preferably, this stock would have plenty of expirations and strikes offered, as well as high open interest. High open interest means a lot of contracts have been opened, which shows how popular that contract is. This should not be conflated with volume, which is just how many contracts are for sale. Since you made it this far, I'll tell you the hack I mentioned in the beginning of this video. If your contract date is coming up and you want to completely eliminate the risk of being assigned, especially if it looks like your contract might go in the money, you can buy to close that contract or do what's called rolling the contract. When you sold your put, you opened the contract. If the price of the contract goes low enough to justify buying it back, you can buy that same put to close the one you opened, allowing you to keep the difference as a profit. Rolling the contract is similar. Once you buy to close your current contract, you sell to open another one for a later expiration. Even if you have to buy back the current contract for a loss, you might be able to sell the later contract for enough to recover your losses and even increase your profits. If you like this video, you might also enjoy this one here on the screen. Subscribe to join the Cash Flow Club and hit the bell for notifications so you don't miss a single video.